Okay, that was a big recommendation.
Trading isn't trade.
Hello, traders, and welcome back to a new episode of Beyond the Charts, where we break down every news event from last week and how it affected the markets. This week was chaotic due to the US government shutdown that kicked off on October 1st, which was Wednesday, after Congress failed to pass a funding bill amid partisan fights over spending and border issues. The shutdown halted non essential government operations, delaying key federal data releases like the non farm payrolls, for example. Uh, it was supposed to be on Friday, October 3rd, but it got pulled off the calendar. This created extra uncertainty, which markets hate because, as you know, markets hate data blockouts because it blindsides Fed decisions and investor bets. The overall impact was as follows. Stocks dipped initially on risk-off vibes. The S&P 500 went down 1% midweek, but recovered on private data strength. Gold surged 2% as a safe haven, of course. And the USD weakened 0.5% versus majors amid cut expectations. Like indices like the Dow were volatile, but ended net flat. Shutdowns historically add short-term noise but fade if resolved quickly. Now, historically, when there is a shutdown, the last shutdown was back in 2018, also when Trump was in office. So, historically, when that happens and we have uncertainty around the monetary policy, that turns out to be dovish, so more rate cut friendly um, uh, than uh, than it being hawkish. Okay, so now I think let's move to the economic calendar and break down the releases that did happen last week, day by day. Let's start with Monday. We only had President Trump speaking. So he addressed the economy, blaming the Democrats, of course, for the looming shutdown and pushing for tariff hikes on China to protect the American jobs. Now, of course, we're back on in Monday, so that's why I'm saying he was saying or he was blaming the Democrats for the looming shutdown. So anyway, no, there were no new policies, but he warned of economic sabotage if funding fails, which actually happened. All right. Um, this speech heightened shutdown fears on Monday, adding political risk to markets that were already jittery about Fed cuts and tariffs. How it impacted the market. It was a risk-off start to the week. The S&P 500 went down 0.5%. The Nasdaq went down 0.6% on uncertainty, and gold went up 0.4% as a hedge against chaos. FX majors, the USD dipped 0.2%, so nothing major. Euro USD gained 0.2%, and GBP USD gained 0.1%, while the USD JPY lost 0.3%. Now, that's it for Monday. Let's move to Tuesday, which was a really big day. So, we had the Reserve Bank of Australia interest rate decision. The previous reading was at 3.6, the forecast was also 3.6, and the actual came in line with expectations at 3.6%. What does that mean? It means that the Reserve Bank of Australia held rates steady, obviously, with a dovish tone amid cooling inflation. So they kept the interest rates a bit elevated, signaling no hikes soon, but watching the global risks like the US shutdown, for example. How did it impact the market? The ASX, which is the Australian index, gained 0.3% because higher interest rates mean more attractiveness or to the Australian dollar. Okay. There was a mild global lift after this release. The Dow gained 0.2%. The gold stayed flat, and AUD/USD gained 0.3% on hold relief, and that's it. The next one was GDP year over year, and yeah, we had year over year and we had quarter over quarter. The year over year was 0.7%. The forecast was 0.3%. It came in line with expectations. That's for the that's for the yearly number. The quarterly number, the previous reading was at 1.7%. And of course, this reading is coming from the UK, okay? So we're talking now about the UK economy. The forecast was at 1.2%. It came better than expected at 1.4%. Now, what does that all mean for the UK's economy, of course? Annual growth beat slightly, or like it was in line with expectations, but the quarterly beat expectations. It means that the economy is still holding up despite tariffs. They're still growing. The economy, the UK economy, is still growing. All right. But the overall vibe is like a moderating. They're moderating the economy fears. Okay. The market impact was the FTSE 100 went up 0.4%. The FX majors, mainly talking about the GBP USD, gained 0.3%. And that's it for UK. Then we had the German CPI, which is the inflation numbers for Germany. The previous reading was at 0.1%. The forecast was a tick up in inflation at 0.2%, and the actual came in line with expectations at 0.2% as well. So what does that mean? It means like there was a mild rise on target. Cooling continues in Eurozone's engine, which supports the ECB easing or the easing path that they're following. All right. Like 0.1% is no big deal, but they should pay attention. And the ECB didn't cut rates the last time because of such events. They decided to wait and see how the inflation goes. And then after they make sure that inflation is doing well, they can start cutting rates again. Next, we had the Chicago PMI. The previous reading was at 41.5. The forecast was 43.4, and the actual came lower than both the forecast and the previous reading. So what does that mean? That's an important reading, especially that it's below 50. So that's a deep contraction in the Chicago PMI. The Midwest manufacturing is getting hurt from tariffs and demand slowdown. That's basically what it means. How did it impact the markets? Industrials dragged, like industrial stocks. The S&P lost 0.3%. Gold gained 0.3% on weakness signals, and USD lost 0.2%. Nothing major on FX majors, actually. Let's move to the next one. It was the consumer confidence. The previous reading was at 97.8%. The forecast was at 96. Sorry, not percent. I said it by mistake. The forecast was 96 points, and the actual was at 94.2. So, which was lower than both the previous and the forecast. So, the consumer's confidence is dropping, which is not a good sign for the economy. All right, guys. Next, we had the job openings. It's still strong, so that's not rate cut friendly. It could mean holding rates higher for longer. The Fed is in no rush to cut rates because the jobs market is doing well and new jobs are opening, so all good. Then finally, we ended the day again with Trump speaking. So, like, what happened is that he doubled down on shutdown blame, same as the blame he started on Monday. So, one day later, he decided to blame them a bit more. He was vowing no compromise on border funding. He blamed the Democrats for not reaching a deal or not reaching an agreement, which escalated the rhetoric amid negotiations. All right. So, of course, this amped up uncertainty with markets pricing in prolonged stalemate because if this stays the case, the Fed will stay blindsided for a while because they need the data, like the NFP, the inflation, all of this will be hard to get without the government offices. So this will blindside the Fed that needs that information and that data to take or to make decisions accordingly. Okay, that's it for Tuesday. Let's move to Wednesday. Wednesday we had all right. So we had the CPI coming from Europe. The previous reading was at 2%. The forecast was at 2.2%, and the actual came in line with the expectations at 2.2% as well. So what does that mean? The inflation is starting to tick up again in the eurozone. So again, we say bravo, Christine Lagarde. You made the right call by not cutting rates in your last interest rate decision or last meeting. All right. The next one is, excuse me. The next one was the ADP non-farm employment change. This number is used usually by traders to um, take a hint about how the NFP would be. Okay, so it gets released 2 days prior to the NFP. The previous reading was minus 3,000. The forecast was an improvement at 52, but the actual came lower than both and even lower than the previous with a contraction of 32,000. Okay, so what does that mean? Uh, this was a shock contraction to start with. Private hiring is negative, signaling a slowdown. Pre shutdown data raises recession whispers. Um, so, how did it impact the market? There was a sharp drop in the Nasdaq, it lost 0.8%. The gold gained 0.6%, and the USD lost 0.4%, while its counterpart, the euro, gained 0.4%. The next we have, or we had, sorry, the S&P Global Manufacturing PMI. The previous reading was at 53, forecast was 52, and the actual was 52. So it matched. There was a mild expansion. Output was up, but unemployment is still soft. So the market impact was as follows. There was a minor relief. The Dow went up like 0.1%. Gold was neutral, and USD stayed flat because it came in line with expectations mainly. Okay. Then we had the ISM manufacturing PMI. The previous reading was at 48.7. The forecast was 49. And guys, remember the PMI, the key number is 50. So if we are above 50, we're expanding. If we're below 50, we're contracting. So the actual came in better than expected and better than the previous, but still contracting. Okay, so it's still below 50. Um, um, it's still like in the contraction territory. Factories are still struggling. Prices are up from tariffs mainly. Okay, the impact S&P lost 0.2%. So you see, guys, that's why knowing how to read fundamentals is very important because if you go to Forex Factory, for example, or investing.com to check the calendar, you'd see a green number and you'd expect markets to go up. But no, the reality is that it's green because it's better than they expected, but it's still in the negative territory, which is below 50. So the S&P lost 0.2%, the gold went up 0.2%, and the USD lost 0.1% despite the green number. So we don't care if it's green or not, we need to understand what each number means. All right. Then we had the manufacturing prices. The previous was 63.7, the forecast was 62.7, and the actual number came in at 61.9. So what does that mean? it cooled slightly more than expected. Input costs are easing, which is good for the manufacturing sector. All right. Stocks and indices were flat, gold was neutral, and the USD was like flat to like minus 0.1%. That's it. And we had the crude oil inventories. The previous reading was a shortage of 0.607. The forecast was a surplus of 1.5, but the actual came in even higher than the expectation with a surplus of 1.792. So that's bearish for oil, and we saw the oil dropping after this release. Now let's move. We didn't have anything on Thursday, so we'll move right to Friday. Now, with the shutdown ongoing, the key non-farm payroll, as I said in the beginning, was pulled from the calendar. Normally, a market mover, guys, we've been in a cycle of an NFP before together, so you know how much it moves the market. Um, its absence fueled speculation and volume. Markets reacted with caution, pricing in weaker jobs data based on the ADP. Remember the one we saw from Wednesday, the one that I told you traders use to take hints about the NFP, which didn't get released on Friday. So stocks were volatile that day on Friday. Uh, the S&P lost 0.5% intraday. Gold held gains, and the USD was pressured. All right. So the S&P Global Services, the previous reading was at 53.9, the forecast was 53.9, and the actual came in line with expectations at 53.9. So what it means is that it's spot on. Services are expanding steadily, offsetting manufacturing worries. The gold was flat, the USD was steady, and the Nasdaq gained 0.3% after this release. And basically, the rest of the numbers were also in line with expectations. Some deviations here and there, but nothing that is of really high impact on markets. So that's it, guys. The overall theme was the shutdown stealing the show or stealing the spotlight, delaying NFP, and creating data gaps, which is not good for the Fed or their decisions, which was amplified, of course, by weak ADP and Trump rhetoric. But from Europe, outside the US, from the UK and Germany, data were steady and PMIs provided balance. Economy was mixed, cooling confidence and jobs versus the stable inflation. I hope this was helpful. If you have any questions, make sure to drop them in the comment section below. Good luck, and see you in the next one. Take care, guys.